and welcome back to the second video in the 9th lecture on Covidenomics. In this lecture we're looking at price gouging. As we noted in the first video, price gouging is a legal term rather than an economic term, and we're sticking with that legal definition. We're now going to look at in this second video the simple economics of price gouging. In other words, just using your first year microeconomics, what do you predict price gouging is going to do? We're then going to move in the third video to a more sophisticated analysis, an analysis that helps us explain what we saw at the end of the first video, which is a difference in behaviour between products sold directly through Amazon and products sold by third-party sellers through Amazon. We're going to start explaining why some sellers price gouge whilst others may not. So here is our simple demand and supply diagram that we're going to use to think about the simple economics of price gouging. On the vertical axis we have dollars, so that's going to be the price. On the horizontal axis we have the quantity of the product sold, and the product we're going to focus on here is hand sanitizer, the one that we looked at in those figures at the end of the first video. We're going to have an initial demand curve, D0, given by this red line, and the pandemic is going to create a shock to that demand. There's going to be a short-term increase in demand up to D1 for hand sanitizer, given by this second red line here. Remember, the demand curve is telling us for any price how much hand sanitizer would individuals like to buy in aggregate. They'd like to buy a smaller amount before the pandemic hits than after the pandemic hits, which makes sense. We've got both our initial short run and our long run supply curves here. Remember back from your first year microeconomics course that the short run supply curve is going to be steeper than the long run supply curve. The short run supply curve is holding fixed costs fixed, whereas the long run supply curve is allowing all costs to be variable. So for example, to the degree that a hand sanitizer production company has 10 machines initially, the short run supply curve would say, well, given those 10 machines, how is it able to increase supply given a change in the price of hand sanitizer? For example, it may be able to run more shifts, it may be able to reorganise the workforce to temporarily raise the output from those machines, or to run those machines with less maintenance. There's a number of things it can do in the short term to increase supply. But the long run supply curve is when we're saying that firm, that business that produces hand sanitizer is able to change the number of machines. The machines are fixed costs and it can alter the number of machines. So in this situation, if the price of hand sanitizer went up, you'd expect it to be more willing to buy extra hand sanitizer machines in the longer term. So in the longer term, it will be able to produce more hand sanitizer than in the short term, given a particular price of hand sanitizer. If you can't remember your theory of the firm and you're saying, I'm not sure where this has all come from, go back and look at some of the videos on the YouTube channel with this video, or just have a flick through any introductory microeconomics textbook, such as Gans, King, Byford and Mankiw, one that I can strongly personally recommend. Using this simple demand and supply diagram, we would predict that our equilibrium before the pandemic will be back here, where the demand curve D0 intersects both the short run and the long run supply curves. So this is the short run supply curve associated with this equilibrium here. It will have a price of P0 and a quantity of hand sanitizer sold as Q0. The notion of equilibrium we're using here is the standard one in economics, and it's essentially the same as the Nash equilibrium we talked about earlier on for game theory. Remember here, everybody is taking the price as given. They're all price takers on the consumer and the producer side. That's built into our demand and supply analysis. So what is occurring here is that given the price P0, consumers would like to buy Q0, that's given by the demand curve. P0, they'd like to buy Q0. Given the price P0, sellers would like to sell Q0, that's given by both the short run and the long run supply curves. Given their number of machines, they'd like to sell Q0. And even if they were able to alter the number of machines in their factory, well, the number of machines they have is exactly the number they would like to have. So given the price P0, sellers would like to sell Q0. Given the price P0, buyers would like to buy Q0. They coincide, there is no shortage, there is no excess supply. And so all of our suppliers and all of our consumers are able to meet their desires. And that's our equilibrium in this demand and supply curve. What happens if there is now a pandemic, an emergency, the demand curve shifts up to D1, and let's assume there is no price gouging law in place, so the market can respond. Well, in the short term, we would expect the price to rise up to P1 SR from P0. That will mean that existing producers are able to increase the quantity. Remember, they're still restricted in that ability to increase. They aren't buying new machines and installing them yet. That's in the long run. And we've not got new entry. New firms aren't saying, hey, I was producing, for example, rum or gin. I can actually produce hand sanitizer. That again is a long run effect, that new entry. So the short run effect is this movement up the short run supply curve. Given the increased price, existing firms would like to sell Q1SR. And of course, given that higher price, that's exactly the quantity that consumers are willing to buy. So the short run impact from the increase in demand is a significant increase in price and a fairly modest increase in quantity. The quantity increase will depend on the flexibility that existing sellers have. If they have very little flexibility, then that short-run supply curve will be steeper, the price rise will tend to be bigger, and the quantity increase will tend to be smaller. As drawn here, this is pretty clearly fitting the legal definition of price gouging. The price is more than double the way that I've drawn it here. But from an economic perspective, what does this increase in price do? Well, it does a number of things. It encourages existing firms to invest in ways that they can increase output sustainably in the long term, for example, by hiring new workers and buying new machinery. It also encourages new firms to enter the industry. Businesses that previously said it's not worth coming in and producing hand sanitizer will now say, actually, at this higher price, it is worthwhile doing that. And in fact, I mentioned gin distillers before. They are one of the groups who found that actually it was more profitable to shift into producing hand sanitizer when COVID-19 struck than to continue producing gin. A lot of bars, restaurants, nightclubs and so on that sell gin were closed, so gin sales dropped. They actually had a reduction in demand. Conversely, demand for hand sanitizer rose. The main ingredient in hand sanitizer is alcohol. And so part of what happened as a result of this increase in price was that companies that used to produce gin started to produce hand sanitizer instead. These changes mean that in the long run, we're going to have a decrease in price again. So the price went up initially from P0 up to the short run price, but then it's going to tend to come down again as existing firms expand their production, as new firms enter, and we move back to the long run supply curve instead of the short run supply curve. That's going to mean that we have a further increase in output as we move towards the long run. So in the long run, the price will partially come back down again, and quantity will expand further than it did in the short run, helping to meet that increased demand for hand sanitizer, albeit we would expect the price probably to be higher even in the longer term. How long does it take to get to the long term or the long run? Well, it depends on the industry. In the case of hand sanitizer, distilleries were actually able to pretty quickly move into producing hand sanitizer, so the shortage was relatively short-lived. So yes, we had that big increase in price in the short term for hand sanitizer, but it started to come back down again as production rose quite substantially within a couple of months. So to summarise, in the absence of anti-price gouging laws, the increase in demand for hand sanitizer associated with the pandemic will lead to a big increase in price initially and a small increase in quantity. But then, as new firms enter, as investment occurs, the price will come back down towards the original price, but probably not that low, and the quantity available will further increase. What, however, if we have anti-price gouging laws? And let's take a simple version where the price gouging law says that the price cannot increase, despite the fact that demand has increased, if that demand shock is due to an emergency such as a pandemic or a hurricane. In that situation, given the price, the quantity that sellers wish to supply will not change. It will remain at our original level of supply. Of course, consumers now want to buy substantially more hand sanitizer. The quantity they wish to buy is out here at Q0D. In that situation, the amount that consumers wish to buy is more than the amount that sellers wish to sell. Now, trade is voluntary. You can't force someone to trade. We don't have people bringing out guns and telling hand sanitizer sellers, look, if you don't produce some more hand sanitizer and sell it to us, we'll commit acts of violence. No, we have voluntary trade here. So if sellers only want to sell Q0S, consumers can't force them to sell more. And so this is the quantity that will actually be produced and sold. Or in other words, the short side of the market will determine the quantity at the fixed price of P0. Because the price can't rise, sellers have no incentive to produce and sell more hand sanitizer. What occurs here then is a situation of excess demand. There is a shortage that's just given by the difference between the quantity that consumers wish to buy and the quantity that sellers are willing to sell given the price. Because the price hasn't risen, no sellers have an incentive to try and produce more. They have no incentive to invest in new equipment. Nobody has an incentive to start producing hand sanitizer if they weren't producing it before. So this situation of excess demand is just going to continue throughout the emergency until the emergency is over and demand falls back to D0. The shortage, due to the price gouging law, leads to what economists call a deadweight loss. In other words, there are potential gains from trade. If the price was allowed to rise, there would be sellers who were willing to sell more hand sanitizer. There'd be buyers who were willing to buy more hand sanitizer. But the law, stops that trade occurring. That's what economists call a deadweight loss. And again, if you want more details on that, go back and look at the earlier videos or have a look at an introductory microeconomics textbook. We're not going to go into that deadweight loss here. So what does the price gouging law do? Without the price gouging law, we'll see a shock in the price. The price will increase of hand sanitizer pretty dramatically in the short term, but that price increase sends a signal to suppliers to increase supply. And you'd expect to see supply of hand sanitizer increasing and that price to start coming down. In contrast, price gouging laws, which prevent the price from rising, stop that signal from working. The price doesn't rise. Because the price doesn't rise, there isn't that supply response. There's a shortage occurring, but of course those who can buy hand sanitizer are not paying any more for it. So The debate about whether price gouging laws are good or bad really becomes a debate about whether that initial price rise is a desirable thing or an undesirable thing. First off, why might it be desirable? Well, as we've already said, it's a price rise that encourages the increase in supply. So it's a price rise that leads to entrepreneurs thinking about ways to produce hand sanitizer. It's a price rise that leads businesses that have never produced hand sanitizer before to work out if they can profitably produce hand sanitizer. In other words, if you're worried about a shortage of hand sanitizer over a significant period of time, then that price rise encourages business to do exactly what you want, which is to increase the quantity of hand sanitizer available. However, it's not unambiguous. Why might the rise in the price be a bad thing? If we don't have a rise in price, we're not going to get the increase in quantity from the market. That may mean that the government has to intervene to provide more supply of hand sanitizer. But even without that, we may still prefer not to have the price rise. The price rise means that the hand sanitizer will go to those who are most able to afford it. Now, in economic terms, that usually doesn't worry us. The idea that someone is willing to pay more for something and that therefore they are able to gain that product in the marketplace. You wouldn't want someone who was only willing to pay less to get that. That would be an inefficient allocation. In fact, the person who got it for less, you'd actually want them to on-sell it to the person willing to pay more, and that would be a gain for both the person who paid less and got the product and then on-sold it, and for the person who was eventually able to get the product. However, with something like hand sanitizer, we're talking about a pandemic and an externality here. Imagine that only a few people were willing to pay a lot for a lot of hand sanitizer, and they just want to make sure they don't run out. They're really sure they want a lot of hand sanitizer, but they're going to keep most of it in the garage. They want to keep stocks just in case. Well, that may not be good for society, because what we want is for everybody to have access to hand sanitizer and to use it to prevent the spread of the pandemic, to prevent the coronavirus from spreading. So in that situation, we may want an allocation that is not done through price, but is done in a situation where everybody gets a share of the available hand sanitizer, even though that available quantity may be less than if the price rose. So there are arguments, both economic arguments in favour of the price rise, but there are also economic arguments when you're dealing with an externality against the price rise. However, most of the arguments in favour of price gouging laws, or in other words against price rises, are actually based on some sort of moral view. In other words, there's a view that somehow it's a bad thing to be profiteering out of other people's misery. That if you raise the price, even though you were willing to sell at a lower price before, you raising the price, taking advantage of the increase in demand, that is somehow unethical or immoral. That you shouldn't be able to profit from a disaster such as a cyclone or a pandemic. Now, I'm not going to get into the moral arguments. However, it doesn't matter whether you agree or disagree with the moral arguments. If consumers view the price rise or price gouging as immoral, then firms themselves, businesses that could raise their prices, may themselves choose not to do so. They may realise that if they do raise their prices, that is going to harm their reputation with consumers, and if they're interested in the long term, they're not just a fly-by-night or a short-term business, but they're interested in selling product not just during the disaster, but after the disaster, and preferably for many years into the future. They will prefer not to get a bad reputation, because that bad reputation can influence their future sales. And we've already seen evidence of that, in the sense that the secondary market sellers from Amazon, who are more likely to be short-term sellers, they were much more likely to raise the price than the Amazon direct sales. So we've already seen some evidence that this reputation effect may have some validity, and that even in the absence of price gouging laws, we may be able to get a situation where some prices rise, but others don't. We're going to explore that more in the next video.